Okay, this is Sudhir with Yash, presenting you Cadillac Commons with our dear friend Joe. So thank you for spending this time with us to learn about investments into Cadillac Commons at Austin. I've known Joe for more than 3 years, and we have co-GP'd together on Green Tree Place, and we have underwrote several multifamily deals as part of our investment journey together. So without taking additional time, I would welcome Joel to speak about this exciting investment, which is very close to Tesla headquarters in Austin. So please keep all your questions to the end, and we will spend as much time needed to answer any question that you might have and make sure you're satisfied by the time you leave this particular presentation. So Joel, take it away.
All right, thank you so much, Sudhir and Yash as well. Again, my name is Joel Fine, and I'm thrilled to be presenting to you information on a project that I'm undertaking along with my co-sponsors that we'll introduce to you tonight on Cadillac Commons. It's a mixed-use development investment opportunity in Austin, Texas. So really excited to share some information with you. And just a reminder, please hold your questions until the end, and we'll try to get through all of the questions that we can. Before we get into the meat of the presentation, I do have a disclaimer that I need to share with you. Just some highlights. This presentation is for informational purposes only. You'll see a lot of forward-looking statements in the presentation, and it's important to understand that these are projections and are not guaranteed. We believe the information we're presenting is from reliable sources, but we encourage you to do your own due diligence. So a quick summary of the project, a summary of the project we're going to be talking about tonight. Again, the name is Cadillac Commons, and it's a 15-acre mixed-use development project in Austin, Texas, in an absolutely amazing location, which we'll talk about in some depth tonight. In the mixed-use development project, we're going to be building a 265-unit Class A apartment complex, along with a retail plaza that's roughly 38,000 square feet. The location, as I said, it's amazing. It's 5 minutes from the brand new Tesla Gigafactory right by Austin and Tesla's international headquarters. And in that location, we expect to see some substantial demand because Tesla is bringing in a very large number of employees over the next several years. Something like 20,000 employees by the time they're fully ramped up, with very few multifamily housing options available and an almost complete retail desert in the area as well. So we're offering limited partnerships available for passive investors who would like to be part of this deal. And our projections show us delivering a 22% per year annualized return based on a 3.5-year hold period. Again, that's annualized, so per year. The agenda that we'll be going through today. First, I'll share some background about the project. Then I'll review the team that's involved, both the co-sponsors as well as some other folks in the extended team. We'll go into a little bit more detail about the location, which we're really thrilled about. It's a lot of the value of the project. We'll talk about the property, our business plan for developing the property. We'll dig into the financials and how we're coming up with the projections. We'll share some of the risks that we see, because any investment like this does have risks, and it's important to be transparent about that. And we'll talk about how you might invest if you're interested in following up. So a bit more on the background of this opportunity. We've got a major supply and demand imbalance, and we see this as a very rare, maybe even once in a generation opportunity, because Tesla is really creating that supply and demand imbalance. Not just Tesla, but a lot of other major employers are coming to the area. Across Austin, but in particular in this neighborhood of Austin, where Tesla is planting its flag. As I said, Tesla is looking at roughly 20,000 direct jobs over time, and they've talked about potentially as many as 100,000 indirect jobs. That would be service and support businesses such as parts vendors, retailers, service facilities, industrial warehouses, and so forth. And in fact, some of those indirect jobs have already gotten an early start. Blackstone has a subsidiary called Link Logistics that has begun planning of an industrial facility just a couple of miles away from our property. Again, on the demand side. On the supply side, creating this imbalance, there's really very little in terms of market rate multifamily housing in this area. In fact, you've got to drive about 5 miles away to find the nearest competitive product. We commissioned a market study last year, back in October, which found a shortage of at least 400 multifamily units by the time we deliver our product. And that's likely to be worse now because that market study was undertaken before Tesla had announced that they were moving their headquarters to the location. So we expect a significant shortage that we'll be able to serve. And again, it's a bit of a retail desert. There are very few options on either the retail or dining side in the neighborhood. So based on all of that, and based on the competitive marketplace and other products in the area, we believe that we'll be able to rent units in our apartment complex, as well as lease up retail space with compelling financial returns. So let's talk about the team for a bit. Again, my name is Joel Fine. I'm with Lakeline Properties. I'm a general partner in 8 value-add multifamily deals so far, with a total of 1,200 doors. I'm a managing partner in ground-up development projects with KBAR, who I'll talk about in a moment, across roughly 157 acres in central Texas. And I'm also a limited partner in, actually it's up to 51 syndications now, well over 15,000 doors, 460 acres of development across, I believe it's 16 states. And that's after I've had a long career as an executive, an entrepreneur, a project manager, and in my earliest days, an engineer. I'm partnered up with KBAR Group. That's Travis Krause and Anna Swanson. KBAR Group is a 3rd generation land developer. They're managing a development of 311 acres total. Some of those projects are partnered up with me, but some independent, with 1,000 lots and 1,600 plus residential doors. They're general partners on 7 different projects. They've got very deep experience, multi-generational experience in residential subdivisions across central Texas. And then, of course, NAMA Partners, your hosts for this meeting, Sudhir Joshi and Yash Havalimane. They are the lead sponsors in a couple of multifamily deals already, with 500 plus doors. General partners in another 12 value-add deals, over 4,000 doors. They've got a long and distinguished record in real estate with multiple commercial land acquisitions in their portfolio. Broadening the team out just a bit, we're working with Novak Commercial Construction on the general contractor side. They are a seasoned builder with a long history in Austin area multifamily projects. We have engaged them for pre-construction consultation already, and we anticipate that they'll have the inside track when we're gathering bids for the actual construction of this project. They've done more than 900 multifamily units, either complete or under construction, and their focus area is central Texas. We're also working with a very distinguished civil engineering firm, Pape Dawson Engineers. They've got more than 5 decades of experience working throughout Texas, and especially in Austin. They've got very deep roots here. They were participants and among the designers of the domain, which anybody who's familiar with Austin understands to be a really iconic landmark project that includes both retail and residential. And then finally, we're working closely with Mark Hart Architecture on the architect side. That's an architecture firm that's been around for some 15 years, extensive experience in our kind of projects as well as similar projects going from high-rise to mid-rise to boutique. They've done a number of very significant projects in the Austin area. And some exciting news about our architect is that they have expressed interest in joining the sponsorship team with a very significant investment in the project. So that way they will, assuming they move forward with this, they will be very tightly aligned with us in being highly motivated to make this project a success. They're very excited about the project. They're optimistic. They believe this is an excellent project, and so they're putting their money where their mouth is. Moving on to talking about this market and the submarket, the Austin and Round Rock region is well known to be very hot at the moment. In fact, in 2021, Yahoo Finance called it the #1 hottest housing market in the US. I've got some statistics on this slide. I won't go through all of them, but let me just touch on some highlights. The population has been growing very rapidly for a long time, and that has only accelerated in the COVID and post-COVID era. And we see no sign of that slowing down. The job market has done well. The GDP of the area is enormous. House prices have skyrocketed. Although in recent days, the housing market has cooled off a bit. There really hasn't been a significant pullback as there has been in other markets. It's really just stabilized, maybe plateaued at a very high level. So there's been a lot of appreciation over the last several years. And then lots and lots of companies have a significant presence in the area. Here are just a few of them that have either headquarters or major operations here. So Tesla is one of a long list of high-tech and other non-high-tech companies that have presence in Austin or are growing substantially in the Austin area. Drilling down just a bit on the location, on the map on the right, you can see Austin is the large gray blob on the left, and the green area is considered part of the Austin metro area, but is outside of city limits. So the subject property over there on the right, the red pin, is where we are. It's in a neighborhood called Hornsby Bend, just outside of the city limits of Austin. It's got quick freeway access to Texas 130, which is the yellow line that goes roughly vertical on this chart, not very far from the red pin. As we've talked about, the Tesla Gigafactory and headquarters is just a few minutes away, but there are other very significant places that are very nearby as well. So convenient to the airport, just 12 minutes away. Downtown Austin is 24 minutes. The domain itself of a major shopping district is 25 minutes away. And Circuit of the Americas, which is a racetrack and entertainment venue, is just a few minutes away as well. So although it's not centrally located in Austin, it's very conveniently located to a lot of important landmarks. Briefly touching on the area demographics, you can see these concentric circles show the 1 mile, 3 mile, and 5 mile radius. And again, without throwing too many statistics at you, you can see some very rapid population growth over the last 10 years, expected to continue over the next few years. Very healthy median household income, which is an important determinant of the kinds of rents that we can expect to get. Higher income is better, and 68,000 to 70,000 is very healthy. Gives us a lot of confidence in our projections for our rent rates. And now, I've got one more slide, and then I'll turn it over to Travis. So this map shows where we are relative to Tesla's land. So that big green area is the land that Tesla has bought. You can see how large it is relative to our, it looks like a narrow wedge, even though it's 15 acres. It's a substantial piece of land, but Tesla has bought, I believe it's something like 2,600 acres in the neighborhood. And the two small Tesla logos is where the factory is, the one on the left. And then the one on the right is where a battery factory is going to be located that Tesla has recently started to get entitlements and permits for. So they are continuing to build and expand on that land. And I would anticipate that to continue given the size and scope of their holdings in the area. And now I'll turn it over to Travis to talk about the property in more detail.
Yeah, thanks, Joel. Yeah, like Joel said, this is we're pretty excited about this project. It's a fantastic area on a macroeconomic scale. But also, whenever you start getting down to the property as well, there's a lot of really neat things that I really love about this project. For example, with this project, if you look, we have about 15 acres worth of land. We have apartments on the left, commercial on the right. And due to a creek that is going through the front of our property, we're actually going to have a unique value proposition to any resident that wants to consider moving into this apartment complex, which is the fact that it's going to be a multi-acre green space. That is a huge deal for people that like to be outdoors. And if anyone likes to be outdoors, it's people that live in Austin. So imagine you're living there and you have a multi-acre dog run, think frisbee golf, and there's a lot of other options that we have that we can expand upon in terms of amenities. So that alone makes the site stand above and beyond anything else. We have direct frontage on Highway Farm to Market 969, which is a corridor that connects Austin proper to Bastrop. As most of you probably know, Bastrop is a booming suburb in the Austin submarket. I think Elon Musk is building projects out there. There's a movies production studio that's going on out there, and that all ties directly into our site. And so what that means is that not only are we hitting the Austin market, but we're also tapping into that potential resident set as well. And we're capturing that business because we're going to have excellent freeway frontage with the Farm to Market Road. And last but not least, just to indicate how exciting this site is and this area is and how it's growing, we recently discovered that we're getting a new neighbor. The company's name is Art Semi. They're in that picture up above. And what they do is they're a semiconductor plant. And what they do is they refurbish semiconductors for the Samsungs of the world and other large technology companies. So this is definitely an up and coming area, and it all ties really nicely together. On the next slide, what you'll see is a picture of the site plan that we have for the project currently. It's 265 units. It's going to be 5-story. Each building is going to be 5 stories tall. We have 1 parking spot per bedroom, which is a nice, comfortable number. On the left-hand side, you'll see a picture of a detention pond. It's not going to have water in it, but it's going to be a biofiltration pond. And so what that means is it's going to have a lot of local plant life inside of it to help filter that water that goes through. It's actually going to be really neat looking for residents as they walk by to get to the private park that they have access to. Each building is going to have elevators. The hallways are going to be air conditioned, and we're going to have a really solid amenity space. So in addition to the green space, we're going to have a pool, gym, package room, one of those Amazon rooms where you can go and you get a key fob and you go get your Amazon delivery. And every ground floor unit is going to have a private yard for your dogs to go do their thing. So overall, this is going to be a nice, solid Class A project. And the demand says that people are looking for that. We're going to be competitive with everything on this side of I-35 in terms of high level amenities for this price range. And on top of that, we have some huge convenience factors locationally. On the next slide, you'll see one of our early, it's one of our newer renditions of Cadillac Plaza. Cadillac Plaza currently is slated to have 38,000 square feet of rentable commercial building space. One of the cornerstone tenants is going to be some type of restaurant. We're hoping to find a brewery that wants to open a brew pub at this location. We have a high level of confidence because one, we have some interested customers. And two, because this is going to be the best place to go grab a bite to eat within 5 minutes of Tesla. Yes, other businesses are going to come in, but we're going to be one of the first. And it's going to be a really solid location with a big green space. I don't know if any of y'all are from the Austin area, but Treaty Oak has a very comparable product to what we're envisioning, where you have a massive field where people can go with their dogs and kids and play around while sipping on a drink and eating some barbecue sandwich. On the right-hand side, you'll see the plaza portion. You have a retail slash office mixed use space in the front. So this is to capitalize on the road frontage portion. So we're looking at tax offices, accounting offices, maybe a Subway, maybe a gym. There's a lot of unmet needs in this area. And down below, there's a huge shortage of warehouse space, especially this proximate to Tesla. The target market wouldn't be large logistics companies, but smaller companies that have mom and pop size, maybe like a commercial AC business where they don't have a tractor trailer, but they need somewhere to keep their vans and keep all their stuff. Huge shortage in the area. It's going to lease up real fast once it's ready. And then when you take a step back on the next slide, you'll see that the overall site plan as it all gets knit together. You'll see on the top side, you have Cadillac Apartments. Every single unit is at a nice slope. The reason why we did that is actually kind of interesting. It's on a grade. The entire project is on a hill. It slightly goes downhill with 969 down below. But what that means is that every single top floor unit, you'll see in a rendition that we made, you're going to have a spectacular view of downtown, which means that we'll be able to charge an extra high premium for those top units. Also, since retail is a shortage in this area, we're going to have another huge competitive advantage because we're going to be one of the only apartment complexes within multiple miles that has an eatery and some retail within walking distance. Sure, you all know in Texas, walkability doesn't really exist. So this is a real standout, especially for a suburban target market. Let's look at some pictures. So this is a rendition. This was made by Mark Hart. As you can see, like he obviously got pretty excited about this project. This is what it could look like from the perspective of 969, that farm to market road that goes in front of the site. Since we control both sides of the property, we can actually create an exclusive gated feel to the property where we have signage on both sides of the road. What that means is as you drive by, you see Cadillac Apartments, Cadillac Plaza, and it just welcomes you to pull in, to grab a bite, or just go home and go to sleep. Also on top of that, it does a really good job at showcasing the big green spaces, the private parks that we're going to have available to our tenants and customers. On the next slide, you're going to see a downhill perspective. This is what it looks like on top of the hill if you took a drone and flew it up a few stories. You see the outline of downtown Austin. Yes, that's kind of what it looks like. And you'll see that it slowly slopes down, and we start seeing some of the neat features that our architect has in mind in regards to oversized patio decks. Obviously, all these buildings are going to have a spectacular view, and overall, it helps, give that nice little pocket community feel. In the next slide, you'll see imagery of the pool. As you can see below, we have that pool. That layout is going to be really neat. Frankly, nothing too special about it, but it is going to be fun. The amenity center is probably going to be 2 stories tall. There's a lot of creative options we're exploring to give it a nice wow factor. I don't have anything specific. We haven't got to that stage yet, but it's going to be pretty cool. I also like this image because it really showcases the massive decks that some of these units are going to get. Just remember, like, big decks mean we get to mark up rent on those units and we make more money. The next view is going to be from the back top floor unit. This is, I think this is one of the penthouse suites in terms of view. It's going to have a spectacular view of the hill country in downtown Austin. I love this unit. If I was going to live in a unit, it'd probably be this one. Note how we have some solar panels. There's some rebate programs with Austin Electric for solar. We've done some early research into that, but there's a good chance that we can get comped on some of the solar that we install if we do that. That helped tie into the Tesla theme that we're going after. Also, added bonus is that those carports will be covered, so we can charge a premium. I'm sure any of you that have let your car out during the summer wishes that you parked under a tree or a carport. Well, here you can, pay an extra so many dollars a month and you get covered parking. And we'll also have a power line going down that, so that we have the option to have someone pay to upgrade their parking spot to a charging station for their electric car. This is something that we probably wouldn't do on a project that wasn't planning on being so heavily motivated by Tesla, but we're expecting a large number of Tesla employees to be customers here. Tenants here. And so with that, we've decided to add that as a potential feature for Tesla employees who are more likely to have Tesla cars to be able to plug in and then their car's topped off every morning, which anyone living in an apartment complex can't really do, except for very few locations that are usually in downtown. After that, let's look at the Plaza site. This is an older rendition of the Plaza, but it does a really good job at demonstrating exactly how much product we can potentially have on this site. On the right-hand side, you see an early version of what the courtyard could look like. There's a slide coming up that kind of digs into that more. On the right-hand side, it shows that we have a lot of options in terms of what we can make these structures look like from a commercial side to give it a nice, classy feel. If anything's going to change on anything you looked at, it's probably this, because these renditions were made a few months ago and we've done a lot of improvements since then to increase the amount of rentable square feet. After that, we see a picture of the courtyard. I wanted to include this image of the courtyard so that y'all could get an idea of what options we have for an open eatery establishment. So imagine that you're here, you're eating, you look downhill and you have this big park and you can take your kids down there. Talking about the park, just 2 more images and I'll pass it back to Joel. This is how big the park feels when you're on the ground floor on the far back on 969. I had 2 scale people put into this park just to give an idea of scope. This is truly a massive area. Soccer, volleyball, frisbee golf, lots of options. And that's pretty much the project. Cadillac Commons is what we're calling it. The name that we're going to advertise under once it hits market, it's probably not going to be Cadillac, but that's the street we're on and that's what we're calling it until we come up with a prettier name. I'll toss it back to you, Joel. Thank you.
All right, thanks so much, Travis. Now let me get into a little bit more on the timeline and the financials for this project. First, I've got the timeline presented here, and you can see that running across the x-axis of this chart. Right now, we're actually in September. This slide was made last month, but we're in the middle of the planning and entitlement phase of this project. which will last through early 2023. We're anticipating roughly March of next year, at which point we will be shovel ready and we will begin construction. Construction we expect to take about 1.5 years, takes us to October of 2024, at which point we will have achieved what's called CO, or Certificate of Occupancy. At that point, we'll begin the lease up process, and we're budgeting roughly 1 year to lease it up and stabilize to prepare it for an eventual sale. So if you add all that up, that's a little bit more than 3 years. We're budgeting 3.5, so we're aiming for an exit right around the end of 2025. On the financial side, we look at sources and uses for the project. Sources is where the money comes from, and uses is what we're going to spend it on. So I'm going to start with the uses and then move to sources. So on the left, I've got the chart with the uses, what we need to spend money on. So we're acquiring the land for roughly $6 million. We expect the construction hard costs to be about $53 million. Soft costs are things like permitting, entitlements, consulting fees, architecture fees, and so forth. A little less than 10 million. And then the financing, the interest on the loans, the debt that we'll be carrying is about 7 million. Add that up and we've got a total project budget of $76 million. On the sources side, that talks about where we're going to get that 76 million. So a lot of that's going to come from lenders. We're lining up a loan on the land for 1.2 million. We're anticipating a construction loan of a little more than 50 million. We'll look at mezzanine debt to cover about half of what's left. And then we're raising the equity in 3 tranches. The first tranche we've already done, that's to acquire the land. Even though we haven't closed on the land acquisition, we have completed the raise for that. We're now in tranche 2, the pre-construction activities. And most of that, nearly all of that, is the soft costs associated with civil engineers and architects and so forth. And then tranche 3 will begin early next year, and that will be the bigger chunk of money when we're ready to begin construction. The fees for this project are fairly typical for a project of this sort. We're looking at an acquisition fee of 2% of the land cost, a loan guarantee fee of 1% of the loan amount, and a developer fee of 4% of the cost of development. Here we have an operating pro forma. What that means is what we anticipate to be the financial results on an annual basis once we have this property completed and stabilized with paying tenants. So you can see here we've got estimates of the rent that we'll collect from each different unit type over on the left. That's the gross rental income across all units. Adding in a little bit of other income, that would be things like fees for reserved parking or other kinds of facility fees, maybe fees for pet rent and so forth. We take out a bit for model units and a bit more to allow for vacancy, since we're not going to have 100% occupancy at all times. And we're looking at an estimate for the gross revenue of roughly 5.9 million. So just a little under $6 million per year in the revenue side. On the expense side, you can see we've got the major expenses outlined here. I'm not going to go through them line by line, but the grand total is a little bit more than 2 million, which leaves us a net operating income before debt servicing of 3.8 million. And we'll bring that number forward in the next step of the financial analysis. So over on the left here, you can see the 3.8 million in the net operating income that I just shared with you. That's just for the apartments. On the retail side, we're looking at gross revenue for renting those retail spaces of just under $1 million per year. Operating expenses are a little bit less than a quarter of that, giving us a net operating income on the retail side of $740,000. Moving over to the right, we add those two net operating income numbers together. We get a total income for this project, combining the retail and the apartments, of just over $4.5 million. The cap rate for Projects like this in the Austin area right now is substantially less than 4.5%. In fact, it's closer to 3.5 to 3.75. We wanted to be very conservative. So by assuming a higher cap rate, that gives us a lower sale price. Obviously, we want a higher sale price, but by assuming a lower sale price, we believe we're being conservative in our assumptions and our estimates. So we believe we can get over $100 million for this property for sale once we've got it built and stabilized. Taking out the loan payoff and the cost of sale, that gives us a very healthy gross profit of $34 million. So the structure of this investment, as I mentioned, we're offering limited partnership shares across 3 tranches. We've already completed the land acquisition tranche. Right now, what you're listening to is the pitch for the pre-construction tranche. And then early next year will be the construction tranche. Our minimum investment amount is $50,000. And this project is open to accredited investors. Accredited, for those of you who don't know, it's not as scary as it might sound. You don't have to take a test. You don't have to get licensed. What it means is you meet certain financial thresholds, metrics in your financial wherewithal. In particular, if either of these 2 statements is true for you, if you are making $200,000 or more in annual income, or you and your spouse $300,000 or more in annual income, or your net worth is $1 million or more, not counting your primary residence, then by definition, you're accredited. So anyone who can meet one of those thresholds can participate in this project.
Let me hop in here real quick, Joel. Sorry for interrupting. Sudhir and Yash, I believe that y'all have some additional options available. I think it'd be good if y'all took a second to, if you think it's appropriate, do it now, talk on it. If not, then we can save it for later. In regards to the accreditation status.
We'll talk about it at the end of the presentation.
Yeah.
Okay. All right, so the returns that we anticipate for our investors, this is our pro forma, what we expect for tranche 2. Again, that's what we're raising for tonight. Development projects are inherently risky. They do have risks, although we believe we've mitigated a lot of those risks, and I'll talk about that in some detail momentarily. But in order to help remove or reduce the risk to our investors, we're paying a very healthy 16% preferred return, and that's per year. So that preferred return will be paid after expenses and debt, but before any split of the profits between the general partners and the limited partners. Beyond the 16%, remaining profit is split 50-50 between general partners and limited partners until our limited partners receive a 20% internal rate of return. And again, that's annualized 20% per year. After the 20% IRR, there's still a bit more profit sharing available to our limited partners of 20%. This bullet in red, I want to emphasize, this is a development deal, so there won't be any ongoing cash flow until the construction is complete and the lease up is well underway. So some investors prefer opportunities that do deliver cash flow. If that describes you, if that's the kind of deal you prefer in your portfolio, you might consider the other opportunities rather than this one. But we believe that it can be an excellent element in any investor's portfolio across multiple projects, some of which do deliver cash flow and some do not. Although it doesn't deliver cash flow on an ongoing basis, it's important to understand that preferred return does accumulate across the project, and it will be paid when the cash flow is sufficient to cover it. What that means is if you invest now, let's say $100,000, the preferred return accumulates at 16%, so that would be $16,000 per year. Even though we're not paying it year by year, at the end of the project when we sell and we have enough to divide up the spoils, at that point, the $16,000 per year will be added up. Let's say it's hypothetically 3 years from now, that would be 3 times 16,000 is 48,000. So we would be paying an investor who invested 100,000, 148,000 back on their investment before we divide up the profits. So based on what we anticipate for the sale price of the asset, changing to a $50,000 investment, we believe we'll be able to pay out just over $100,000 total on that investment for an equity multiple just over 2, giving us an internal rate of return of 22.4%. Sorry, my throat's getting a little dry. One of the things we like to do to get a sense of the risk we're undertaking is to do what's called a sensitivity analysis, where we change some of the assumptions in our underwriting and then see how those changes affect the outcome of the project. So in particular, two of the most important numbers or metrics for this project are the cap rate on sale and the schedule for the construction. So as I said earlier, the cap rate we're assuming in our underwriting is 4.5% on sale. A lower cap rate means a better sale price, a higher sale price, which we like. But a higher cap rate would mean a worse sale price, which we don't like. We can see here, if we go all the way to the right of the first table, a 5% cap rate is very pessimistic, way higher than anything in Austin is experiencing now. And even with a cap rate that high, the rate of return for our investors is still a very healthy 20% per year, with an equity multiple of 1.9, meaning our investors will nearly double their money across the 3.5 year hold. Similarly, on the construction timeline, the base case, the 3.5 years we're assuming, gives us that IRR of 22.4%. But if we experience a delay of 6 months, we move to the right of the bottom chart, we still get a very healthy IRR, internal rate of return to our investors of 21.6%. So this shows us that this project is not particularly sensitive to changes to the cap rate or the construction timeline. And in fact, what we see is that the return to the general partners varies quite widely, but the return to our limited partners stays within a pretty narrow band. And that's one of the ways we're de-risking, is essentially, as a general partners, we are taking on that risk. And we're doing so because we're so confident in this project. So let's talk about the risks a little bit. Let's drill down. The risks for this project are not unusual at all for a development project. In fact, you might see this on the same chart on pretty much any development project you might be interested in. Going through line by line, the risk areas include entitlement. We have to work with the county and to a lesser extent the city to get permits. However, we're in the extraterritorial jurisdiction of Austin. We're outside city limits, which simplifies a lot of the process. And we've already initiated the apartment site plan. We've gone back and forth with Austin a couple of times, so that process is underway. On the construction timeline, we've all heard in the news about supply chain issues with lumber and other parts that are important for a building. We've built in some contingency, and as I showed in the last slide, even if we threw that contingency and take another 6 months, it really doesn't affect the returns to our investors in a significant way. On the budget side, we all know, we've all heard about inflation increasing over the past year. I'll talk more in detail about this in the next slide, so let me save that. On the utility side, we need to make sure we've got electricity, water, and sewer on site in the capacity we need in time for this project. We've already engaged in significant levels of discussion with the various utility providers. We've got verbal commitments from them, and we're now working towards written commitments. And some of those written commitments will require some investment, and that's among the uses that we will be putting the money that we're raising now. On the debt side, we'll be working on the construction loan between now and March. And in fact, roughly in the January timeframe is when we expect the construction loan to be tied up. We've got a lot of lenders who are very interested in this project for really the same reasons that we're excited about it and the same reasons we've been sharing with you: the phenomenal location and the supply and demand imbalance that we're seeing. Final risk I want to talk about is the real estate values and cap rates. The US economy is facing some headwinds. We hear about perhaps a recession in the news that could affect property values. But as I said, Austin has plateaued. It hasn't really dropped. And Austin's continuing to attract very strong inflows of population that really underpin that plateau and maybe even will lead to continued appreciation over time. So this project's location in the Austin submarket really plays well for us. Talking in more detail about the inflation risk, as we all know, inflation is fairly high and really is showing, well, I wouldn't say no signs of abating. We are seeing some relief now at the gas pump and so forth, but it's always a risk. And of course, there are negatives to inflation. Construction costs will rise. And one of the ways we deal with that, we mitigate that, as we go through the process of preparing and getting this project shovel ready, we'll work with our contractor to put in place a GMP, a gross maximum price bid, before the construction begins. And that'll put the onus on our general contractor to acquire the material at the numbers that they say they can when we begin the project. We also have a pretty healthy budget contingency built into our underwriting of 5%. Also on the negative side for inflation is once we start leasing up, our operating costs will increase for property management, for marketing, for repairs, maintenance, and so forth. On the flip side, inflation can actually be mitigated or work to our advantage in that in an inflationary environment, rents do tend to move up along with other costs of living and wages. Again, as I mentioned, Austin's got a substantial net in-migration flow that's keeping demand very healthy. And the increase in interest rates over the past several months, along with the appreciation in home prices, have caused many buyers to pause in their pursuit of homes. They still need a place to live. People who decide not to buy after all, they don't just disappear. And so maybe they either become renters or they remain renters longer than they anticipate. And so that fuels the demand fire. So on balance, we've got offsetting effects from inflation, which does create some uncertainty as far as the timing of when price increases will hit, but it isn't necessarily a strictly negative outcome for a development project. More on the investment process. Again, our minimum investment for this project is $50,000. We are accepting money from self-directed IRAs or solo 401ks. Self-directed IRAs in particular have a custodian in the middle of the process. That custodian is likely to want to spend some time reviewing documents. They're going to have their own process. So anticipate that and start early if you're looking at taking money from a self-directed IRA or other retirement vehicle to fund this project. On the timeline, well, today is September 7th. That's where we're presenting this. We're looking to get soft commits in about a week. A soft commit is essentially just an expression of interest. We'd like you to tell us, hey, we'd like to invest, and here's the amount we intend to invest. But as the name implies, it's a soft commit. It's not a hard commit, so it's possible to back out at that point. We'll send documents out, and over the following week, we'll ask you to review the documents and sign and return those documents electronically. So 2 weeks from now is when we would look for signed investor documents, and that's what we call a hard commit. And then we'll have a little bit more than a week beyond that to bring funds in. So we're looking for funds by the end of the month. We do expect this investment to oversubscribe, so we encourage you, if you're interested, to pursue this quickly. And if you are interested, please reach out to one of the sponsors for detailed instructions as to how to begin the process. To recap this project, we're looking at a 15-acre mixed-use development project in Austin, Texas. The mixed-use development will be a 265-unit Class A apartment complex, a 38,000 square foot retail plaza. The location is just amazing, as it's 5 minutes from Tesla and 12 minutes from the airport, and a very short drive to many other important landmarks, with a major supply and demand imbalance resulting from Tesla's significant move into the area. We're offering limited partnerships for passive investors who'd like to be part of this. And our projections show an annualized return of 22% per year for our passive investors after all fees and splits based on a 3.5-year hold. And with that, I'm going to open it up to questions. Sudhir, I'm going to let you moderate the questions if you like.
All right. There is the first question, which is about knowledge on